right? Lots of stocks to watch and lots of corporate developments, which we will highlight in a bit from now. But let's stay with the global stuff. Robert Sockin is global economist at Citi, and Ed Yardeni is president at Yardeni Research. Both are joining us right now to take some questions. Great to have both of you with us here. Thanks very much for your time. Ed, if I can start by asking you what you made of, Secretary Yellen's comments, which kind of seemed to be in contrast to what we heard from Powell at the press conference. Powell basically said that depositors should assume that their deposits are safe. And here she kind of ruled out any blanket insurance for all deposits. Which one is it?
That's a good question. I mean, it really makes your head spin to see the kind of talk that we had today and its impact on the marketplace. I think Janet Yellen misspoke. I think that Powell's position is probably the one that's going to prevail here. And the idea is that, yes, the government, the Treasury, that is, and the Fed are not in a position to insure deposits, but they are in a position to guarantee that the banks themselves will remain safe. And so I think that's the fallback position that Yellen's going to have to get back to really quickly here.
Robert, so what's the takeaway? The market, till the Treasury Secretary spoke, seemed to be of the view that we'll probably get another quarter, percent rate hike, and that's it from there. Though the FOMC statement itself is pointing to the uncertainties of the banking developments on the larger economy. So how should we read and interpret the next couple of months with respect to policy tightening?
That's a great question, and thanks so much for having me. And I think going into this meeting, it was a very tricky meeting for the Fed, and I think the way that they handled it really highlights the dual objectives that they're trying to balance and the uncertainty of the situation. So the Fed is trying to balance its fight against inflation, at the same time maintaining financial stability. And right now where we are, we don't know how much of the banking stresses that we've seen are going to prove more long-lasting, and we don't know how much they're going to move into the real economy. And so the tone of the Fed very much reflected that. They did still hike 25 basis points, but I think the key to that communication is that they held the dot plot at just one more hike, which was the same as it was in the prior meeting, and they really highlighted and softened up the language about what they're going to do next, and really leaving a lot of optionality on the table. So it depends really what you think the Fed is going to do next. It depends on how much you think these banking stresses are going to tighten financial conditions, how much these things are going to be destabilizing, and how much they're going to play into the real economy. Our view is that these stresses will largely subside over the next several weeks, and that's going to allow the Fed to pivot back to focusing on inflation, which still remains fairly intense and fairly high. So we haven't changed our Fed call. We think they're still going to go to 5.5 to 5.75. I know that's on the more hawkish side, but it's really based on this view that we think that these stresses are probably going to subside over the next several weeks, and it's going to focus again back on inflation. But I think the Fed meeting today, the real takeaway is this is a very uncertain situation, and the Fed's very open to seeing how the data play out, and then they'll move based on those factors.
All right, noted that, Robert. But Ms. Yardeni, coming back to you then, what are you factoring in terms of how many more rate hikes we see? Is it just 25 basis points and then we're done? Or do you believe you have a couple of more in the offing, provided we don't get any more banking shocks that come out from the United States?
Well, I think that the Federal Reserve may very well go one more time by 25 basis points, though I think the fact that we now have this banking crisis and that the Fed understands that the banking crisis is equivalent to some increase in the Fed funds rate. As you mentioned, Powell suggested it might be equivalent to 50 basis points. I think it could be equivalent to 100 basis points. Nobody really knows. As Robert said, there's a lot of uncertainty here about how it plays out. But I think first and foremost, the Fed and the Treasury are going to have to get their act together and make sure that they're using the exact same language to describe the importance of keeping the banks safe. And I think if they can undo the damage from what Yellen managed to do today, then I think the banking crisis will be equivalent more to 50 than 100 basis points. And it probably will mean that the Fed doesn't really have to go again.
Ed, what does it mean for global markets, equity markets in particular, this kind of environment, in your view?
Well, I think that we've seen the dollar weaken here on the perception that the Fed is getting close to done. The ECB may still have further to go because they lag behind the Fed. And so a weaker dollar, generally speaking, tends to be good for global alternative markets, whether it be emerging markets or European markets. But of course, European markets have lots of their own problems, and the ECB is still talking rather aggressively about fighting inflation. So I don't know that it radically changes the outlook for investing on a global basis. I still think, you have to look for opportunities around the world. The U.S. isn't particularly cheap, but then again, some of the cheap markets are cheap for a reason.
Got that. Robert, just another question. Markets have been whipsawed, and even some of these banking issues are a result of the manner in which rates are moving, right? I keep going back to an analogy of a slightly reckless driver where you are, hiking, and then suddenly there's talk of cutting. I mean, there are a lot of expectations on cuts as well as we get into 24, right? So your thoughts on how this will play out and whether just this forward and backward momentum on interest rates in such a large market, whether that could lead to further complicated consequences, whether it's economy or whether it's banking?
That's a great point to make. And, just to highlight the uncertainty again of the situation, I mean, the moves that we've seen since these banking stresses have emerged in markets have been huge. And at times you see, Treasury yields move up significantly. You've seen them move down significantly. You've seen stress in a lot of different areas. I really think that's the market trying to figure out exactly how deep and how far these stresses go, and that's probably going to continue for some period of time into the spring because you're likely to get more episodes of banking stress at certain players in the U.S. You're going to get market fears about banks in Europe. They'll probably flare up at different times. So I think we're in for a period of volatility and uncertainty, and certainly that doesn't help from an investing standpoint or from a stability standpoint. And I completely agree with Ed's point that I think that part of the reason that we think these stresses are going to subside over the coming weeks is that, in this episode, policymakers have moved swiftly, they've moved powerfully, they've kind of learned the lessons from 2008, that you shouldn't let these issues fester, and that the response has been fairly rapid and impressive. On top of that, you're dealing with banking systems that are well capitalized and well regulated overall. So I completely agree that in order to get some of these market swings and to calm down and maybe to get the system stabilized, we need sort of a coherent, continued policy response to these issues. And then again, for us, we think once you get to that place and that these issues move more towards the back burner, you're going to get back to focusing again on the real side of the economy and inflation, which still remains intense. And that likely means some more policy tightening. But, no doubt that this will be a fairly volatile period for at least several more weeks.
Okay, so I guess strap up. The roller coaster continues to move on. Thank you very much, gentlemen. Great speaking with you this morning, and thank you for the perspective on all the announcements that we've heard overnight. We will take a break, but before we do that, President Murmu conferred the Padma Awards last evening. Top industrialist Kumar Mangalam Birla was among the Padma Bhushan awardees. The Padma Shri was conferred upon one of the most loved voices in the market, ace investor Rakesh Jhunjhunwala, posthumously. We leave you with glimpses from the ceremony.